The savvy investors know to make their moves first, while the media sings praises of prosperity and politicians make promises of limitless growth. A few perceptive individuals are already quietly exiting. They notice the early warning signs before they escalate. They sense trouble brewing before it erupts. In the crucial moments leading up to a disaster, they act decisively, while everyone else is blissfully unaware. October 28th and 29th, 1929, were no exception. While millions of Americans were caught up in fantasies of wealth that would never materialize, the real insiders were making strategic decisions that would shape the next decade. The key question isn't whether the crash was inevitable. It's about what the insiders understood at that moment and how they responded. Ordinary investors were still chasing after the dream. Intoxicated by the roaring 20s like never before, stock prices surged, doubling and tripling, while radio companies, automobile makers, and consumer goods businesses saw their values soar month after month. Everyday folks who had never dabbed in the stock market were taking out loans to buy shares. Taxi drivers were dishing out stock tips, and shoeshine boys were analyzing trends. Everyone thought the good times would roll on forever. Yet, beneath the surface of this euphoria, a select group of experienced investors were interpreting entirely different signals. Joseph Kennedy, who would later lead one of America's most renowned political families, was already preparing for the impending crash months ahead of time. While the masses reveled in record highs, Kennedy quietly started offloading his investments throughout 1929. The legend has it that he decided to pull back after his shoeshine boy offered him stock advice. But the truth was more strategic. Kennedy grasped the concept of leverage better than most. He recognized that when everyone is borrowing to invest in stocks, the entire system is vulnerable. A slight tremor, and it could all come crashing down. By the end of October, Kennedy wasn't just distancing himself from the market. He was actively shorting it. Bernard Baruch, the legendary financier who had advised presidents and made fortunes during earlier crises, was also trimming his positions throughout that summer. Having experienced the panic of 1907, Baruch was attuned to the warning signs. When speculation reaches a boiling point, when the market is awash in borrowed money, and when everyone is convinced that prices will only go up, that's when it's most likely to tumble. Baruch later expressed that he could feel the tension swirling in the air around Wall Street. The conversations, the bravado, the reckless optimism all felt eerily reminiscent of previous crashes. By October, he had shifted most of his portfolio into cash and government bonds, bracing for the coming storm. It wasn't just individual investors who sensed a shift. The Federal Reserve, America's central bank, was tightening credit throughout 1929, attempting to temper what they deemed reckless speculation. Interest rates rose from 5% to 6%, sending a clear message to those paying attention. The era of easy money was coming to an end, with central banks deciding to pull back. The bubble that had inflated for so long was finally starting to deflate. Yet the majority of investors seemed oblivious to the warning signs, lost in a haze of profits, just like a patron who didn't notice the bartender cutting them off. In the weeks leading up to the crash, European money began to exit American markets. British investors in particular had been watching as U.S. stock prices soared to ridiculous heights. They recognized the simple truth. What rises too high will inevitably fall, and often with a bang. So, in a quiet but strategic move, British banks sold off their American assets throughout September and October, ensuring their funds were safely back across the Atlantic by the time the crash hit. The indicators were all there for those who knew how to interpret them. For several weeks, margin calls had been piling up. When investors borrow money to buy stocks, they have to deal with margin calls if prices dip. This means brokers ask for more cash or threaten to sell the stocks. By mid-October, brokerage houses were inundated with these calls. Savvy investors recognized this as a serious warning sign. If people were already struggling to cover their debts in good times, what would happen when the situation turned dire? It was a conclusion anyone familiar with past market panics could easily reach. Moreover, trading volumes had skyrocketed to levels never seen before in October. At first glance, it appeared to be a sign of enthusiasm. In reality, it was a signal of desperation. Heavy trading often indicates that major players are offloading their stocks to smaller investors. The pros were selling to the amateurs who still believed in the rising tide. This pattern is typical of every market bubble. The insiders exit while the outsiders pour in. October 1929 was no exception to this trend. Even corporate leaders were unintentionally signaling the brewing trouble. Throughout the year, insiders had been selling their shares in unprecedented numbers. When those in charge of companies start to offload their stock, it usually means they're privy to information that the average investor doesn't have. This wasn't just random selling, it was a systematic withdrawal. The shrewd minds behind these corporations were making their escape, just as the smart investors outside were doing the same. Take Jesse Livermore, for instance, considered one of the best speculators of his time, who had been preparing for disaster since early 1929. Livermore grasped crowd psychology better than nearly anyone else. He had profited greatly from previous market panics by opposing the prevailing sentiment. As the year progressed, Livermore accumulated significant short positions, and not merely avoiding the impending crash, but positioning himself to benefit from it. When stock prices plummeted, his bets would yield remarkable profits. By late October, he was poised for one of the biggest triumphs of his career. Meanwhile, the bond market had been sending out warning signs for months. Typically, as stock prices rise, bond prices fall as investors shift their focus from safe assets to riskier ones. However, in late 1929, bonds started to strengthen even as stocks continued to climb. This disconnect left many observers scratching their heads. Sophisticated investors were subtly shifting their focus from high-risk speculation to safer havens, preparing for an impending downturn even as the headlines basked in reports of prosperity. Signs of turbulence were emerging in international currency flows. Throughout the 1920s, the dollar had enjoyed a robust position, luring foreign investments into American markets. However, by the fall of 1929, there were clear signals that this confidence was beginning to falter. European central banks started to stockpile gold rather than accumulating dollars, signaling a quiet but significant vote of no confidence in the stability of the American market. When central banks begin to doubt, it often leads to a ripple effect where private investors start to reconsider their positions as well. Most alarmingly, the market's very foundation was becoming alarmingly shaky. By the end of 1929, around 40% of stock purchases were made with borrowed funds. Investment trusts, essentially the mutual funds of that era, were taking on debt to buy stocks and other trusts that were also heavily leveraged. This was a precarious situation of leverage stacked upon leverage, creating a pyramid of debt that supported inflated valuations. Those in the know understood the impending doom. When everyone is in debt and prices start to decline, the selling becomes a runaway train. Forced sales trigger further sales, leading to a cascading collapse of the entire structure. Seasoned professionals had witnessed this scenario play out in other markets with other bubbles and crashes. They were aware that financial markets are bound to the law of gravity. What rises without solid backing will inevitably fall. The only question left was when. By late October 1929, the timing was becoming alarmingly apparent. The savvy investors weren't just pulling out, they were positioning themselves to profit from the disaster they anticipated. While newspapers continued to herald a new era of enduring prosperity, the real players were calculating their next moves, and they recognized that markets are cyclical. Bubbles are destined to burst, and that leverage comes with a price tag. They had studied the past and were bracing for history to repeat itself with brutal accuracy. For them, the crash was anything but unexpected. It was an inevitability they had been gearing up for all along. And in the hours leading up to the crash, the atmosphere was tense with frantic phone calls, urgent meetings, and desperate attempts to salvage whatever could be saved. But for those paying attention to the warning signs, October 28th wasn't about panic. It was about execution. They had diligently prepared their strategies over the preceding months, and now it was time to carry them out with precision. As trading commenced on October 28th, the market opened to a wave of heavy selling. The Dow Jones Industrial Average had already taken a significant tumble the previous week. Yet many investors clung to the belief that this was just a minor setback in an otherwise unstoppable bull run. The informed investors, however, were acutely aware that this marked the onset of the avalanche they had long expected. While amateur investors held onto their positions, hoping for a rebound, the professionals were accelerating their exit plans. Jesse Livermore was fully engaged during those pivotal moments. For months, he had been establishing his short positions. But on October 28th, he significantly ramped up his contrarian bets against the market. Livermore had a keen insight. Once panic selling kicks in, it tends to snowball. Margin calls force investors to liquidate their stocks to secure cash, which in turn drives prices down further, leading to even more margin calls and additional forced selling. It becomes a ruthless cycle that obliterates everything in its path. Livermore made sure he was positioned to benefit from each stage of this downward cascade. The communication lines between Wall Street and the opulent estates of Long Island were aflame with activity. Affluent families who had amassed their fortunes over the years were hastily unloading positions they had held for ages. These weren't mere speculative maneuvers. These were crucial steps to protect generational wealth. The old money families grasped a truth that many newer investors seem to overlook. Markets can wipe out decades of gains in just a few days. It's far wiser to sell too soon than too late. On that same day, October 28th, European investors were also making their last moves. British and German banks, still holding American securities, hurried to offload them at any price they could get. They had witnessed the American bubble grow excessively and wanted to distance themselves from the impending downturn. The transatlantic cables buzzed with a relentless stream of sell orders coming in from London, Paris, and Berlin. Overseas capital was fleeing the U.S. at the speed permitted by the technology of 1929. Corporate executives were confronted with their own critical decisions. Many had received stock options as part of their remuneration packages, worth millions on paper, but only if they could be exercised and sold before the crash reduced their value to nothing. Throughout the day, these insiders were rapidly turning their theoretical wealth into cash, acutely aware of the storm clouds looming over the economy. Meanwhile, the Federal Reserve was quietly deliberating. Central bank officials had been convening in emergency sessions throughout October, weighing their options in response to the mounting instability. Some advocated lowering interest rates to bolster the market, while others insisted on purging the speculation, regardless of the short-term fallout. While they engaged in debate, the savvy investors weren't waiting around for a government solution. They were actively seeking their own strategies. Bernard Baruch spent October 28th making calls to his network of financial contacts. Having survived several market crashes by nurturing relationships with informants during crucial times, he was getting the confirmations he needed. The onslaught of selling pressure wasn't originating from nervous small investors. It was something much bigger at play. Institutions, banks, and affluent individuals were signaling that the good times were coming to an end. When the major players act together, resistance is futile. The commodity markets were sending out clear warning signs, which the savvy investors were paying close attention to. Throughout October, gold prices had been on a consistent upward trend, indicating that investors were looking for safe havens. Meanwhile, oil prices started to dip. As traders expected a drop in industrial demand, agricultural products faced pressure too, with farmers fretting about their ability to secure credit for the upcoming planting season. Movements in the commodity sector can often hint at stock market crashes just days or weeks ahead of time. While the professionals were piecing together these clues, amateur investors remained fixated solely on stock prices. Investment trusts, akin to the mutual funds of the 1920s, were also grappling with a crisis of confidence. Many had taken on debt, hoping to enhance their returns during the bull market. Now that prices were sliding, they found themselves facing margin calls from lenders. Trust managers faced a tough dilemma. Either sell off their best assets to raise cash or default on their loans, risking bankruptcy. Either option would exacerbate the market's downturn. The smart money recognized this precarious situation and adjusted their strategies accordingly. Banking stocks were among the first to display significant weakness on October 28th. Professional investors were acutely aware that banks had substantial exposure to stock market loans, meaning a market collapse could lead to catastrophic losses from unpaid loans. The early sell-off in banking stocks wasn't random. It was strategic speculation driven by a deep understanding of the financial system's vulnerabilities during turbulent times. Despite the downward trend on October 28th, there were still voices calling for calm and predicting a swift recovery. Editorials in newspapers urged patience, government officials talked about the economy's underlying strengths, and corporate leaders claimed their businesses remained fundamentally solid. However, the smart money was not swayed by these reassurances. They were focused on the flow of transactions, keeping a close watch on credit markets, and calculating the mathematical likelihood of impending trouble. The options and futures markets, though significantly smaller back in 1929 compared to today, were also signaling clearly to those who knew what to look for. Put options, profiting when stock prices fall, were trading at unusually high volumes. This wasn't merely a case of investors selling stocks. They were also purchasing insurance against further declines, a clear indication of those bracing for disaster. As the day wore on, the selling pressure mounted, and orderly liquidation initiated by professional investors was beginning to stir panic among smaller players. Margin calls were inundating brokerage houses, signaling growing stress throughout the market. Investors who had taken out loans to invest in stocks found themselves in a tough spot, having to sell at exactly the worst time. Meanwhile, those in the know watched this wave of panic selling with a calculated eye. They recognized that when fear grips the market, it creates golden opportunities for those with cash and a bit of bravery. The events of October 28th hinted at the even more severe collapse that would follow on October 29th. However, for those who had been getting ready, the crash wasn't a catastrophe. It was a chance to gather their rewards. They had spent months laying the groundwork for their strategy, and now it was time to harvest the benefits of being prepared when everything began to crumble. During this tumultuous time, the affluent estates in Newport and the Hamptons buzzed with unusual activity. As October 28th turned into the 29th, personal secretaries worked tirelessly through the night, collaborating with brokers to execute complex transactions that would safeguard wealth while many others were asleep. These weren't hasty decisions made in a panic. They were meticulously planned maneuvers that had been in the making for some time. The old money families recognized that preserving wealth required proactive measures before the crowd realized there was real danger, not after Joseph Kennedy was particularly active during those late night hours. His team of advisors and brokers worked in shifts, implementing a strategy far more sophisticated than just selling off assets. Kennedy was not only liquidating his remaining long positions, but also building substantial short positions across various industries. He understood that the impending crash wouldn't hit all sectors equally. Some would plummet more dramatically than others, while a handful might endure. Kennedy's approach was precise, focusing on the most vulnerable areas and steering clear of businesses that might survive the turmoil. In the exclusive dining rooms of Manhattan's top clubs, whispered discussions permeated the air throughout the night of October 28th. These gatherings weren't about socializing. They were urgent strategy meetings where America's financial elite formulated their responses to the crisis unfolding around them. Information flowed like water among this close-knit circle. They exchanged insights about which banks were most at risk, which companies were leveraged too heavily, and which sectors would bear the brunt of the fallout. This was insider trading in its most straightforward form, yet entirely within the legal bounds of 1929 regulations. Jesse Livermore operated from his private office, equipped with multiple telephone lines connecting him to brokers nationwide. With a month of intensive study on the dynamics of past panics behind him, Livermore understood that real profits would come, not just from foreseeing the crash, but from grasping its rhythm. The initial wave of selling would pave the way for larger short positions at more advantageous prices. The panic phase was shaping up to deliver the highest profits, while the moment of final capitulation would mark the right time to start covering those short positions and brace for the eventual rebound. Throughout the night, the telegraph lines linking New York and London were buzzing with an unprecedented flow of financial communications. British investors weren't merely divesting from their American assets. They were strategically positioning themselves to cash in on the impending downturn they foresaw. The Bank of England had been quietly stockpiling gold for months, gearing up for a flight to safety that would ultimately boost sterling at the dollar's expense. British merchant banks were setting up credit facilities aimed at scooping up American assets at rock bottom prices once the panic peaked. Meanwhile, the foreign exchange markets were exhibiting signs of underlying tension. The dollar had enjoyed a strong run throughout the 1920s, buoyed by capital inflow into American stocks. Yet, by the wee hours of October 29th, subtle changes in currency trading hinted at a crack in global confidence. Swiss banks were converting dollar deposits into gold. French investors were shifting money into government bonds. And even Canadian banks were scaling back their exposure to American financial entities. Those in the know recognize that currency shifts often precede stock market disasters by mere hours or days. Corporate boardrooms across the U.S. were buzzing with urgent meetings as October 29th loomed closer. Executives who had seen their stock prices soar during the decade now faced the grim reality of potential ruin. Some resorted to drastic measures to prop up their shares, while others quietly offloaded their personal investments before the situation deteriorated further. The most astute leaders understood that their top priority was not their shareholders, but their own survival. They had witnessed earlier crashes wipe out companies and careers, and they were determined not to be among the casualties. The options market, albeit rudimentary by today's standards, was experiencing remarkable activity in the early hours of October 29th. Wealthy investors weren't just purchasing put options to profit from anticipated declines. They were also selling call options to generate extra income from positions they planned to exit anyway. This level of portfolio management required both capital and know-how that the average investor simply lacked. Professionals were finding ways to extract value from every facet of the impending collapse. As October 29th arrived, banking executives faced a serious fork in the road. Many banks had extended massive loans backed by stock portfolios, which had since plummeted in value. Some bankers were discreetly calling in loans from their most reliable clients, attempting to lessen their risk ahead of the real mayhem that was about to unfold. Banks across various cities were setting up lines of credit with correspondent institutions, anticipating an imminent liquidity crisis. Those with the foresight weren't waiting for government intervention or regulatory action. They were already putting their own survival strategies into motion. The commodity exchanges also began to reflect the financial tremors building beneath the surface. Gold futures steadily climbed as investors flocked to safe havens, while silver also saw price increases, albeit with more fluctuations. Meanwhile, oil futures started to dip as traders braced for a drop in industrial demand that would inevitably follow the market crash. Agricultural commodities faced their own set of challenges, with farmers anxious about financing their next planting season. The movements in these markets signaled to astute investors that the stock market's impending collapse was part of a larger economic crisis. As October 29th approached, investment trust managers found themselves in a dire predicament. These early mutual funds, having borrowed heavily during the bull market to enhance returns, were now grappling with falling stock prices and receiving margin calls from lenders. They faced a choice between liquidating their top assets for cash or defaulting on loans, which could lead to bankruptcy. Either option risked further accelerating the market's downturn. The savvy investors knew how to leverage this situation and were poised to capitalize on the forced sell-offs that would result. The professionals weren't merely betting against individual stocks. They were strategically shorting entire sectors likely to crumble under the forthcoming panic. Real estate firms, consumer discretionary brands, and luxury goods manufacturers became prime targets for these shrewd short sellers. They recognize that during economic downturns, consumers tend to cut back on non-essentials first. Companies that thrive during prosperous times would likely face the most severe repercussions when the financial tide turned. Behind the scenes, the Federal Reserve was also taking discreet actions, opting for more subtle measures than the dramatic interventions seen in later crises. Some regional Federal Reserve banks quietly tightened credit access for member banks in an effort to curb speculation without inciting panic, while others readied themselves to offer emergency loans to banks that might encounter depositor runs. The central bank was carefully balancing its approach, trying to navigate the crisis without exacerbating it through hasty decisions. Meanwhile, insurance companies were making adjustments to their portfolios throughout the night, leading up to October 28th. Given the massive stock portfolios they maintained to back policy obligations, insurance leaders recognized the risks they faced if stock prices plunged. They could encounter regulatory demands to reduce exposure. In response, some proactively sold equities and shifted to safer government bonds. As the market continued to decline, many investors began to secure themselves by establishing hedging positions to safeguard their portfolios. The actions of insurance companies were especially noteworthy, as they represented some of the biggest institutional players of the time. With October 29th looming, private banking relationships were put to the test. Wealthy families who had long held accounts with the same banks through generations started to quietly shift their assets to other institutions they believed would fare better in the impending crisis. These were more than mere financial moves. They signified a loss of faith in certain management teams and their business models. The savvy investors weren't just focused on protecting their wealth. They were strategically positioning themselves with the institutions they expected to emerge stronger from the turmoil. The market's psychology was changing in ways only seasoned professionals could fully grasp. Indicators such as trading volume, bid-ask spreads, and order flow dynamics were all hinting at an increase in institutional selling. Meanwhile, individual investors still hung on, hoping for a rebound. But the larger players were acting with increasing urgency. The professionals sensed that a pivotal moment was near, a time when selling would become relentless, causing prices to tumble steeply. As dawn broke on October 29th, the environment was ripe for one of the most catastrophic financial disasters in history. However, for those who had been perceptive enough to heed the signs and adjust their positioning, the crash was anything but a disaster. It was a golden opportunity. They had been preparing for this moment for months and were primed to capitalize on the panic that would devastate the savings and dreams of countless ordinary Americans. The proactive investors had acted early, and now they stood on the brink of reaping substantial rewards for their foresight. The morning of October 29th unfolded in a frenzy, one that the astute investors had helped orchestrate through months of meticulous planning. While novice investors clung to the hope of recovery, the professionals were executing the final phase of their strategies, which would shape their fortunes for years to come. When the opening bell rang, it unleashed a wave of selling pressure unlike anything Wall Street had ever experienced. Yet this wasn't merely panic. It was a carefully executed demolition by those who grasped how financial systems give way. When pushed to their limits, Jesse Livermore was notably active in these early moments, increasing his substantial short positions as prices plummeted. He understood that the real gains during a crash are often found not in the initial drop, but in the acceleration phase, where forced selling generates its own momentum. Livermore had closely studied every notable panic since the 1870s and recognized the mathematical inevitability of what was transpiring. As leverage unraveled in a declining market, selling would breed further selling, leading to an implosion of the entire structure. The phone lines linking Wall Street to the rest of the country quickly became jammed within just an hour of trading. However, the savvy investors had a plan. They weren't relying on public networks for their communications. Instead, they had secured private lines, dedicated telegraph systems, and even messenger services, allowing them to make trades while regular investors struggled to get through. This edge in communication wasn't just a stroke of luck. It was infrastructure they had put in place specifically for situations like this for the key players. The crash of 1929 didn't come as a shock. It was a well-orchestrated shift of wealth, transferring resources from the many who were unprepared to the few who had taken the steps necessary to safeguard their investments. While countless Americans watched their savings disappear almost overnight, these savvy investors were raking in profits that would multiply over generations. The harsh truth is this: the markets reward those who prepare, not those who cling to hope. They favor those who can interpret the signals over those who buy into illusions, and they invariably hurt the masses while enriching those courageous enough to go against the grain. History may not repeat itself, but if you disregard its lessons, it can have devastating consequences.